Welcome to Investor in the Family Radio, a podcast dedicated to helping you make better investments in less time so you can live more life. My name is Brian Bain and I'm your host. You can find more shows and other valuable content at investorinthefamily.com. Well, on today's show, Adam Gallus, the Dividend Sensei, is back with us. Adam, welcome to the show.
Thanks for having me back, Brian.
Always great to have you. And this time, we're talking about a recent article that Adam wrote for Seeking Alpha called 4 Reasons 3M Could Crush the Market Over the Next Decade. And so I'm really excited to talk about 3M. This is not a company that I have researched myself, which makes it that much more fun to talk to you about it, because I know that whenever you put out an article on a company, you do your homework. And so you know 3M. And so could you do us a favor and just kind of share for people who have not read the article, what's the general thesis of your article and your thoughts on 3M?
Well, so 3M is one of those, what's known as a dividend aristocrat. Technically, it's a dividend king, meaning that it's grown its dividend for at least 50 straight years, specifically in this case, 59. And the great thing about dividend aristocrats is that, dividend growth stocks, studies show that they tend to outperform over time, and specifically in the case of dividend aristocrats, I mean, if you look at since 2000, they've absolutely crushed it. I mean, 10.4% annualized returns versus the market's 5.4. So they've doubled the market's performance. They've had 27% lower volatility while doing it, and
you said the aristocrats have earned 10.4% since 2000.
Yep.
Wow. And the markets were what?
5.4.
And that's the S&P?
Yeah, S&P 500. So they've doubled the market's performance with 30% lower volatility, which is just remarkable. And the thing, of course, people will point out is like, okay, well, the aristocrats generally, they have stable business models, the ones that are, most famous, things like Coca-Cola, Johnson & Johnson, Procter & Gamble. And so what some people will point out is like, okay, well, Coke back in the 80s, they were growing really fast and people still loved soda and they were branching out into international markets. And it was all boom times for Coke and Procter & Gamble. Now, of course, they're struggling and growing much slower, and so they're higher yield and slower growth, and so their chances of beating the market are much slimmer. But what excites me about some of these industrials, especially like 3M, is that, so for example, over the last 30 years, 3M has generated 12.3% annualized total returns.
The last 3 years?
30.
Oh, last 30. Wait, okay. Last 30 years, 3M has produced 12. Say it again.
12.3%. And that, that's absolutely remarkable. The market over that time was 10.5. So it beat the market by 25% a year for 30 straight years. And people will say, oh, sure. But now it's, the law of large numbers. It's so big that how are they going to be able to keep doing that? But so there, I fall on study show. It's called the the Gordon Dividend Growth Model, based by a Nobel Prize winning economist from the 50s, who showed that over decades, that total returns generally follow yield plus long-term dividend growth, assuming the payout ratio stays the same, because dividends are basically paid out of earnings and cash flow. So basically, yield plus the earnings growth. And so if you look at that, 3M, their analysts are projecting over the next 10 years, it's going to be 9.6% earnings growth, which means that the dividend growth should be around the same. And so add that to yield, you get 12.2% projected total return potential. And more importantly, management has said...
Wait, hold on. Just 1 minute. Okay, so analysts are predicting 9.6% earnings growth over what period of time?
Over the next decade.
Okay.
And management says the same. They're saying we can, over the long term, 3M's goal is 8 to 11% EPS growth with 100% free cash flow conversion. So essentially, free cash flow per share should grow about 9.5%. That's what management says. So that...
Sorry, I did that. No, this is great. I'm just trying to take notes. You put a bunch of numbers out there that I couldn't catch real quick. Analysts are predicting 9.6% earnings growth over the next decade. And if you add that to the yield, you said that works out to what?
12.2. which is essentially what they've done over the last 30
Right.
years.
And then management has a goal for earnings growth of 8 point what?
8 to 11.
Okay.
Which, so mid-range, that's 9.5.
Right, which is right what analysts are saying.
Exactly. So
Right.
3M is basically their long-term plan is to maintain the same total returns that they've just done over the last 30 years.
Well, when you've done it for 30 years, it gives you a little bit of credibility when you predict that going forward. That's for sure. Well,
absolutely.
So, but you mentioned, people say the critique of, well, it's so big, how can it keep growing? But you said the Gordon dividend growth model. How does the Gordon dividend growth model counter that argument?
Well, so it's actually really simple. I mean, basically, total returns from any investment is your current income, so your current yield, the earnings growth, and any multiple expansion. Now, over time, valuations tend to be mean reverting. So they come back and they cycle around a relatively fixed point, which is why I like to use 10-year projections, because over a 10-year period, it's like sectors move in and out of favor. Industries will, sometimes they're cyclical, so they'll have boom and bust cycles. But over a long enough period of time, valuations tend to cancel out. So at that point, instead of 3 variables, you just have 2. You've got the current yield, which is also fixed, and then it just comes down to what the long-term earnings growth will be.
Gotcha. Okay. So the Gordon dividend growth model is what got you to focus on earnings growth, and earnings growth, according to analysts and management, is pretty great.
Oh, absolutely.
Gotcha. Okay.
But
go ahead.
But of course, the thing with that is like, you can't just look at, for example, if you look, my source for the 10-year projections is Fast Graphs. And if you look at some of these projections like BP, the analysts are projecting earnings growth of 47% annualized over the next decade. And it's like,
what?
Yeah, it's like, I get oil prices are going up and they're increasing production and margins are going up because they're cutting production costs. That's close to basically doubling every 18 months. You're not going to do that. That's crazy.
That is strange.
So that's the second part of it is I don't just look at, analyst projections. I actually, analyze the business model and say, how realistic is that? How are you going to get that 9.5? What's the catalyst for that?
Gotcha. So tell me this. So with 3M, a huge company, and from a consumer perspective, I've grown up seeing the 3M logo on all kinds of different like household products and things like that. Is there any like core like moneymaker breadbasket for 3M, or is it really just tons and tons of small products that all aggregate into one big company?
Oh no, they are super diversified. I mean, they've got the consumer facing stuff, things like Post-it notes and the face masks and the stuff that everyone knows. But they sell over 60,000 products in total in over 200 countries, and 5 major business segments. Most of their stuff is on the industrial side, so that they'll provide things like tapes and sealants and ceramics and insulation for electronics and touch screens and various kinds of products in things like electric car batteries and renewable energy systems. And so that's what really has me excited about 3M, because I mean, you're right. They're a huge company, about $33 billion in annual sales. So how are they going to be able to, grow that at around, 5 to 6% a year in order to be able to, get that bottom line to grow at close to double digits? And so that's where it comes down to, what are their growth catalysts? What are the growth markets that they're looking at? And it's like, 3M industrials in general grow just slightly faster than the global economy in general, which is usually 3 to 4% a year. So the industrial sector's revenues about 3.5 to 4.5% a year. And so a good industrial company with, strong brands and quality management and good use of bolt-on acquisitions over time and new product launches, which 3M is famous for, they can generally grow at 0.5 to 1% faster than the industry. And so you can get, organic growth, meaning not through acquisitions, about 4 to 5%, and that's about what when the global economy is growing at its normal pace. Like this year, for example, 3M is projecting 3.5% organic growth, and some of their top sectors like healthcare, it's going to be, they're saying about 5%. So without any acquisitions, their healthcare segment will grow their revenue by 5%. And then through cost cutting and greater economies of scale and increased efficiencies, they're saying, oh, we can get close to 10% earnings growth off of that.
Right. So no specific catalyst per se, but just with industrials in general, with them growing faster than the global economy, that gives them a little bit of a, I guess, edge per se to help them, meeting these goals and stuff.
Well, actually, no, I'm sorry, I kind of went off on a tangent there trying to explain that. They actually do have plenty. I mean, like, for example, 3M, their big thing right now is, they're working on components for electric car batteries.
Gotcha. And
batteries in general. So, I mean, as lithium ion takes off, they're cashing in on that. The same thing with data centers. I mean, data is growing exponentially thanks to increased mobile and 5G and the Internet of Things. They're cashing in on data centers. And in terms of just growth,
you mentioned data centers, which again you just said this, but I missed it. Obviously benefits from mobile growth, and I'm assuming like 5G rollout and things like that.
Oh yeah, so that's the thing. You've got 5G, you've got the Internet of Things, you've got driverless cars. All of that is going to be huge for data centers, and 3M they make critical components for that.
Gotcha. I love a company that does not sound exciting at all, but is smart enough to be, have just produce really crucial, important elements that aren't necessarily exciting for very exciting industries, and they just get to ride that wave.
Oh, absolutely. 3M is like the quintessential picks and shovels company that has its hand in everything. For example, like air quality. In countries like India and China, they're booming. Their populations are especially in India, population is growing, but their air quality is absolutely horrible. So 3M is coming up with world-class filtration and air quality and water filtration systems, and all these kinds of basic infrastructure that we talked about in our last interview with Brookfield. It's like by 2040, $100 trillion in new infrastructure is needed. 3M has its hand in that. Data centers, electric cars, driverless cars, they have their hands in that. They have their hands in everything. Providing these essential little services and products that make the essentially the future of technology and the entire global economy work. And the best part about it is they make some of the best high-end mission critical components. And so, as I explained in the article, these guys have been around 116 years. They've been working with some of their customers for 50, 60, 70 years. They literally work with their industrial customers, and they sit down with them and they say, what is it that you do? What is it that you need? Let us come up with a proprietary thing that works. It's tailor-made for you. And then once they start selling that customer is not going to want to leave. And even though the margins on those products are high, the average cost to that customer for their cost of goods sold is about 5%. And so even though 3M is managing to mint money, I mean, they've got 17% returns on capital, 15% free cash flow margin. It's such a small little five and dime that their customers aren't going to leave. And so their moat is so wide. They have such good pricing power. It's really a thing of beauty.
And that one of the questions I was going to ask, but you really, I think you just nailed it, was like, what is 3M's thing? They've got over 60,000 products in over 200 countries, and they're, they're in all kinds of industries and all kinds of sectors and everything else like this. But for a company to be this successful for this long, they're not just, throwing mud at a wall and seeing what sticks. And they've got some kind of core identity who the company is. And I think you just nailed it. Like they're the company that they can do anything. They come to companies and say, what can you do that we can create a solution for? And that's what drives their product lines. And that may not be the complete answer to it, but that's a part of it for sure. that's a significant positioning in the industry, really.
Oh, it is. But their biggest, the biggest competitive advantage by far has to be the R&D, because really their innovation, it is at the heart of the company. For example, some of your readers might know Google was famous that they had their engineers spend 10% of their time just working on side projects. Hey, come up with the new great thing that we can end up monetizing. Like Gmail was one of those 10% projects. 3M, their senior engineers, they spend 15% of their time just working on side projects. That's how they came up with the Post-it note, which, that became this, they became so famous for. And that's how they came up with, like, for example, in the last 5 years, 33% of their sales are from brand new products launched in the last 5 years. They've got over 8,100 researchers operating in 36 global R&D facilities, working on 46 different product lines at the moment. They're generating 3,000 patents a year. They already have 115,000, but they just keep minting more of them. And so that's the thing, is like they do it. But what's even more impressive is that how efficient they are. It's remarkable. They're Boston Consulting Group. Every year they do an analysis of like the top R&D companies and who's the most efficient at it. And in 2017, they found that 3M was the second most efficient at its R&D spending in the world, second only to Apple. And to give you an idea of how good it is, in 2016, for every dollar in R&D that 3M spent, and they spend a lot, I mean, close to $4 billion a year, and that number is climbing. For every dollar they spent in R&D in 2016, in 2017 they generated almost $9 in extra gross profit.
You said for every dollar in 2016?
Yes. So basically, for every dollar in R&D that they spend, the next year they'll generate an extra $9 in gross profits off of that. And for comparison, the top 10 companies in that survey generated 5.5 on average. So it's almost double. And that's the top 10 in the world.
That's amazing.
So, I mean, 3M is just, it's one of my favorite sayings, from Fraser was, if less is more, think how much more is. Meaning, if you can have laser-like focus and be super efficient at stretching each dollar of R&D, then imagine scaling that up to $4 billion a year, fixing that to about 5% of R&D or 5% of revenue. And as your revenue scales up, you keep increasing your R&D, and you keep doing it in a way where the researchers are making every dollar as efficient over time.
Do you have any, and this may be beyond the scope of your expertise on 3M, do you have any insights in terms of like what makes what they do in R&D so much more efficient than everyone else? Again, that may be beyond your scope of knowledge, but I was curious if you have any insights on that.
Well, I mean, I haven't actually like interviewed any of these researchers.
Sure. I mean, that's a pretty.
I would say that
question.
The biggest thing in general with any kind of company that's super successful over time and that's manages to maintain its competitive advantage is the corporate culture. Is like other companies will say, hey, R&D is important to us and we're all about the innovation. But when you see some of these industrial dividend aristocrats and kings, you can just see that, they are such good capital allocators that if you look at their returns on capital, it's just 2-3 times the industry average. It stays that way over time. They make smart acquisitions. In the case of R&D, the fact that they're engineers, the motivation. I mean, they spend 15% of their time just doing their own thing, and then they get paid bonuses. Hey, if you invent the next Post-it note, it's like, hey, big bonus for you. And so that's kind of thing. They figured out how to make the corporate culture so focused on R&D. I mean, they actually have a chief technology officer whose entire role is to oversee the R&D department. And that guy's been there for 23 years with the company. And so, he's helped to build and craft this corporate culture that's all about R&D. He's streamlined it. He's perfected it. And that's the thing I love. If you look at 3M, their management team, their CEO that just left, he's now the executive chairman. He was with the company. He started, his entire career was with 3M. 39 years he was with the company. The new CEO is the former COO, so the chief operating officer, the guy who was literally overseeing running all the operations day to day and making everything super efficient. He's been with the company 30 years. He's the new CEO. And so it's like you just look.
Amazing consistency.
Oh, absolutely. Their bench is the deepest, is one of the deepest in the industry, which is what I just absolutely love to see, because that is the heart of dividend growth investing, and especially with dividend aristocrats, is you've got a stable business model, you've got a wide moat, good pricing power, good competitive advantage, consistent growth in revenues, earnings, and cash flows over time. But at the end of the day, what creates that is the management. Running these companies, my goodness, I run a small business myself. The taxes alone make me want to cry, each April. I can't imagine what running a global conglomerate must be like. And that's why, shareholders, we pay management the big bucks to handle that for us. And so you want to make sure that management's doing a good job. And 3M, through the last 30 years, the last 60 years of consistent dividend growth, they've proven that their business model works. Management knows how to allocate shareholders' capital efficiently, how to make money for us, and how to, more importantly, reward us with that dividend growth. Because at the end of the day, the reason I don't own non-dividend stocks is like, hey, if your earnings quadruple over a decade, that's great. But unless I actually sell the shares and the price and the multiples expand and the price has gone up, I can't actually profit from that.
Right.
But with something like 3M, you buy them 30 years from now, that dividend is going to be, 10, 15, 20 times greater. And your yield on cost. So if you invest $1,000 now, you'll be getting 50% of your investment back every single year. So
wait, say that again. If you invest $1,000 now, you get 50% of your investment back every year.
Well, yeah, because the dividend essentially will grow to the point that the yield in 30 years will be 50% of your original.
Oh, okay, right, okay. Down the road, you will. Okay.
Yes.
Gotcha. Okay. Tell me this. So we've said lots of great things about 3M. But I know one of the things you like to focus on, and I really respect that in your articles, is risk factors. So this sounds great, and I have no reason to think it's not great. Are there any concerns or things to be worried about regarding 3M for an investor?
Yeah. So, there's always going to be risk factors in every industry. And so, 3M with industrials it is a cyclical industry. Now, the great thing about 3M is 50% of their revenues are from what's called fast consumables. So, things like the Post-it notes, things like filters that it's used up really fast. So that creates very consistent recurring revenue. But the other 50%, that is for more, traditional industrial components. And so that is going to rise and fall with the global economy over time. So, they've proven that with their low payout ratio over time, that their dividends going to remain safe. It's not going to be an issue for them. But investors have to realize that, in terms of the share price, that's going to rise and fall over time. And another thing to remember is that, currency risk. 63% of their sales are from overseas because they're a global company. And so if the US dollar gets stronger, that means that local sales will translate into fewer dollars for accounting purposes, for earnings, and for dividend purposes. Now, the good thing is that over time, currencies tend to be mean reverting, so that'll cancel out. But in the short term, it can end up hitting. It can create either tailwinds or headwinds. For example, in Q1, the dollar, even though it strengthened this year, because it weakened so much in 2017, in Q1, currency effects actually boosted their bottom line by 4.2%. But in the next year, for example, if U.S. economic growth is stronger and our interest rates are rising faster than, say, in Europe or in Japan, where interest rates are not going up at all and their economy is relatively weak. If the dollar gets stronger, then, a year from now, they might be reporting, well, growth was 4.2% slower. And for something, for an industry where 5% revenue growth is, solid, and 10% earnings growth is the goal, if the bottom line ends up falling 4% because of currency, well, that's 40% of your growth gone right now.
Right.
Yeah.
Right.
But of course, that cancels out over the long term, which is why management says, hey, over the long term, we can get that 10% earnings growth.
Right.
So you've got cyclicality, you've got currency effects. Another thing that could affect margins in the short term is just like raw material costs. I mean, they because they have 200 factories around the world, and a global supply chain, they're able to source products, in the cheapest way. But at the end of the day, if you're using things like, petrochemicals and steel, that those are commodities that if the price goes up, it's going to hit margins. And for example, there in the U.S. factories, obviously steel tariffs, that's going to be a huge thing. I mean, steel prices depending, there's different grades of them, but certain steel prices are up 40% in the last in 2018 so far because of steel tariffs. So that's something that you also have to consider. And then, of course, the broader risks of a trade war. I mean, we're not in one yet, but the risks are rising, and the more tariffs we throw up on countries like China and on Europe, they're throwing up retaliatory tariffs, the same 25%. And so that's the thing, is like with 63% of their sales internationally, a lot of that in Europe, a lot in Asia is their fastest growing market. Chinese sales are booming, over 5% organic revenue growth. So, if we end up in a trade war with China and they start throwing up 25% or more tariffs, and just, there goes a potential growth market for you.
Sure.
Now, so, I mean, again, that's not likely to persist over time because trade wars are, so painful, so destructive that they generally only last a few years. And that's assuming we start one at all. But that's another thing to consider.
Anything regarding 3M we haven't discussed yet you want to cover before we wrap things up?
No, that's about it.
I mean, yeah, this was fantastic. Adam, as always, thanks for your great work. Thanks for sharing your time here. And thanks for your ongoing, just high value contributions for all of us at Seeking Alpha.
Well, my pleasure, Brian. It's always great to be here.
The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.